$100 doesn't look like the beginning of wealth. It looks like a grocery bill, a dinner out, a pair of shoes. For most people, it's money that comes and goes without changing anything. But one afternoon, the wealth builder looked at a fresh $100 sitting in his account and decided not to spend it. Not because it was a large amount of money, because he wanted it to become something more. Like most beginners, his first instinct was to find the perfect investment. He searched for the best stock to buy. One video promised a company that would explode. Another claimed artificial intelligence would create overnight millionaires. Someone else insisted cryptocurrency was about to begin another bull market. Within an hour, he had collected dozens of opinions, but almost no understanding. That's when he realized something that permanently changed the way he thought about investing. The question wasn't, what should I buy? The question was, what kind of investor am I trying to become? Most beginners believe investing is about picking winners. In reality, successful investing is about building a system that keeps working regardless of headlines. The first $100 rarely changes your financial future because of its size. It changes your future because it shapes the habits every future investment will follow. The first investment isn't really about money, it's about identity. The moment you begin thinking like an owner instead of a consumer, your financial decisions start changing. You stop chasing excitement, you start building ownership. That's why this first $100 matters far more than its purchasing power. It marks the moment earned income begins turning into productive assets. And that transformation follows a sequence. Miss one step, and the system becomes fragile. Understand every step, and your first investment becomes the foundation for decades of wealth. Let's begin with the step that most investing videos overlook. Step 1. Make sure the money can stay invested. The wealth builder was ready to invest immediately. Then he asked himself one simple question. What happens if my car breaks down next week? It wasn't a pessimistic thought. It was a practical one. Investing only works when your money has time to grow. If you're forced to sell because of an emergency, you're no longer investing for the future. You're solving today's problem with tomorrow's wealth. That's why experienced investors recommend building an emergency fund before investing aggressively. Even a small cash cushion reduces the chance of selling investments at the worst possible moment. History shows that markets generally rise over long periods, but they never rise in a straight line. Corrections are normal. Temporary declines are expected. Selling during those declines because you suddenly need cash can turn temporary losses into permanent ones. The Stoics understood this principle long before stock markets existed. They believed wisdom meant preparing for uncertainty rather than reacting emotionally when it arrived. An emergency fund isn't exciting. It doesn't produce impressive returns, but it protects the investments that eventually will. If your first $100 is the only thing standing between you and a financial emergency, keeping it in savings may actually be the better decision. Ownership works best when patience is possible, and patience becomes much easier when you have stability. But suppose your financial foundation is already in place. You have enough cash to handle life's unexpected expenses without touching your investments. Now your first $100 has a different purpose. It can begin working instead of waiting. Step 2. Buy ownership, not predictions. When the wealth builder returned to his research, one thing became obvious. Everyone claimed to know which company would dominate the future. Very few admitted they could be wrong. The reality is much simpler. Even professional fund managers struggle to consistently outperform the market over long periods. Research has repeatedly shown that many actively managed funds fail to beat broad market indexes after fees. That doesn't mean individual companies can't produce exceptional returns. Some certainly do. The challenge is identifying them before everyone else does. Instead of trying to predict the next winner, the wealth builder chose a different approach. He bought a small ownership stake in hundreds of businesses at once through a broad market index fund. Instead of depending on one company, he owned businesses across many industries. Some would struggle, others would thrive. Together, they reduced the risk of one bad decision destroying years of progress. Think of it this way. Owning one company is like planting a single tree and hoping it survives every storm. Owning an index fund is like planting an entire forest. Some trees will grow faster than others. Some won't survive, but the forest continues growing. The wealth builder wasn't chasing headlines anymore. He was quietly becoming an owner of productive businesses around the world. His first $100 wasn't buying excitement. It was buying participation in the global economy, and that simple shift in thinking leads directly to the next decision, one that determines whether investing becomes a one-time event or a lifelong wealth-building system. Step 3. Turn investing into a habit. The wealth builder made his first investment. There were no flashing numbers, no celebration, just one quiet decision that changed the direction of his financial life. Most people stop here. They believe investing is about making one good decision. But wealth has never been built by a single investment. It's built by repeating good decisions long enough for time to multiply them. That's why the next step matters even more than the first. The wealth builder opened his banking app and scheduled an automatic transfer. Every month, another $100 would move into his investment account without requiring another decision. It seemed almost too simple, but simplicity was its greatest strength. Human beings are inconsistent. One month we feel confident. The next month we're uncertain. Some days the news makes us optimistic. Other days it convinces us a market crash is just around the corner. If investing depends on how you feel, you'll always find a reason to wait. Automation removes emotion from the process. The decision is made once, but the system keeps working for years. This approach is known as dollar-cost averaging. Instead of trying to predict the perfect time to invest, you invest a fixed amount at regular intervals. When prices fall, your money buys more shares. When prices rise, it buys fewer. Over time, this reduces the pressure of trying to time the market perfectly. History has consistently shown that patient investors who remain invested often outperform those who repeatedly jump in and out of the market chasing the perfect opportunity. The wealth builder wasn't trying to outsmart millions of investors. He was building a system that didn't require perfect predictions. His greatest advantage wasn't intelligence, it was consistency. And consistency leads to another lesson that many beginners never learn. Step 4. Ignore the noise. A few weeks later, financial news filled every screen. One expert predicted a recession. Another insisted the market was entering a new boom. Social media overflowed with people claiming they had found the next investment that would make everyone rich. The wealth builder felt the temptation. Maybe he should sell. Maybe he should chase something with bigger returns. Then he remembered why he invested in the first place. He wasn't trying to become richer next month. He was trying to own productive assets for the next 30 years. Daily headlines are designed to capture attention. Long-term investing is designed to create wealth. Those two goals rarely point in the same direction. Markets have survived wars, recessions, financial crises, pandemics, political uncertainty, and technological revolutions. Yet diversified markets have historically continued growing over long periods because businesses keep creating products, solving problems, and earning profits. Short-term volatility isn't evidence that investing has failed. It's simply the price investors pay for long-term growth. As the Stoic philosopher Epictetus taught, focus on what you can control. The wealth builder couldn't control interest rates, elections, or market corrections. But he could control how much he invested, how often he invested, and whether fear controlled his decisions. The market rewards ownership. It rarely rewards panic. That realization transformed investing from an emotional game into a disciplined practice. Step 5. Think beyond your first $100. Years passed. The original $100 became impossible to separate from everything that followed. Not because it disappeared, because it became part of something much larger. New investments were added. Dividends were reinvested. The businesses he owned continued growing. Some struggled. Others flourished. But together, they kept producing value. The first $100 had never been the goal. It had been the proof. Proof that income could become ownership. Proof that ownership could become assets. And proof that assets, given enough time, could become freedom. Many people wait until they have thousands of dollars before they begin investing. They believe the amount is what matters most. But wealth doesn't begin when you reach a certain number. It begins the moment your money starts working harder than you do. The first $100 teaches every lesson the next 100,000 will require. Patience, discipline, consistency, emotional control, long-term thinking. Those principles don't change because another zero is added to your portfolio. That's why the size of your first investment is almost irrelevant. Its greatest value is psychological. It's the moment you stop seeing money as something to spend and start seeing it as something that can own productive assets on your behalf. The wealth builder eventually understood that financial freedom wasn't built through one brilliant investment. It was built through thousands of ordinary decisions that most people considered too small to matter. Individually, each investment seemed insignificant. Collectively, they changed his future. That's the quiet truth about wealth. It rarely begins with a fortune. It begins with a decision to become an owner, one small investment at a time.